Welcome to the Financial Planning Certification Exam Lessons podcast. This is going to be a sample lesson of the full series of audio lessons which are available at the website fplessons.com. That means financialplanninglessons.com, fplessons.com. At the website, you can find the full series of audio lessons. The full series of audio lessons consists of 6 different sections. Those sections include general financial planning principles, professional conduct and regulation, insurance planning and insurance products, investment planning, tax planning, retirement savings and income planning, and finally estate planning. A total of 6 different sections. You can buy the individual sections at the website fplessons.com. All right, let's get on to this sample lesson. This is Financial Planning Lessons, audio lessons for the Financial Planning Certification Exam. This is Part 6, covering estate planning, narrated by Nika Maramadi. This is Lesson 1.
Hello, and welcome to a review of estate planning for the Financial Planning Certification Exam. We are going to begin our discussion with community property versus non-community property. Okay, so this is controlled by state legislation, all right, so it varies by state to state. So estate planning in a community property state is going to be pretty different from a non-community property state. So community property is a form of ownership held by spouses in the 9 community property states. California is the most well-known community property state. So when property is held in these community property states, such as California, both spouses own a separate, undivided, and equal interest in the property. Equal is the key word there. So basically, each spouse owns 1/2 of the interest in the property. So even if only one spouse initially purchases or acquires that property or earns the income that is used to benefit both individuals in the couple, then the community property states emphasize the efforts of both spouses, both indirect and direct, that lead to the acquisition of property or income. I kind of like to think of this as, someone has to stay at home and handle the home, make sure things are running smoothly, manage the household, fill the fridge, right? Go shopping for the groceries. And doing all of this supports the other individual in the marriage to go out and make some money and then allow the household to afford those groceries. So community property states argue that regardless of who is making the money on paper, it is the contributions of both spouses that allow the realization of this income or the purchase of these assets to happen in the first place, right? It's a team effort, like someone needs to make the sandwiches for lunch and the other needs to then eat that lunch and go make some money, right? So as a result of this, even if only one spouse is earning income, it is presumed that the efforts of the non-working spouse contributed to the benefit of all of the property in the marriage, right? I don't know how else to explain that, but that's what kind of helped me understand community property. So both spouses need each other in order to gain income or property, no matter who is actually making it or buying it on paper. Okay, so as a result, all property that's acquired by the spouses during the marriage is presumed to be community property, right? Because both their efforts and their sacrifices and their hard work, wherever it may be, contributes to the realization of this income and this property. Okay, there's no survivorship rights. This is very important for clients in community property estates. There are no survivorship rights. Therefore, a will is needed and the property will then be subject to probate. Okay, no survivorship rights. That is very important for community property estates. All right. So, community property interest is kind of, the characteristics, how it works, etc. So, income that's earned by spouses or only one spouse during that marriage is considered community property interest. Appreciation on solely owned property that is attributed to the contributions of the non-owner spouse, right? Doesn't matter who actually owns it, the appreciation is attributed to the contributions of the spouse that does not own the property. Okay. And separate assets that have been commingled, that is the key word, commingled with community assets, where you can no longer determine which are separate and which are community assets. That's very important in terms of planning for couples in community property estates. So make sure that if a individual in a marriage would like to keep some certain assets, not only just in their name, but out of this community property interest, then they must basically not touch it. The moment they get married, they cannot touch the assets that they've acquired. Basically, if you've got a bank account, let's say your checking account, and you're just wild. You're one of those folks that has $1 million in their checking account. Hope you don't, or at least hope you don't after an engagement with a financial planner. But anyway, let's say you got $1 million in a checking account and you want to make sure that after you get married that your spouse cannot access that money and, if anything happens, it's yours. Not just in title, but truly and utterly yours according to state law. Okay? After your marriage is legal, you cannot add money to that, right? Because they see any income earned as owned by both spouses. Basically, you can't add money to it. I'm sure you can, I guess you could just take it out and spend it on something, right? But if you take money out and put it in a joint account or something where the assets are commingled, well then, yeah, that's your own boo-boo. Basically, unless you're going to take the money out and spend it for yourself, you should just stop and not touch that money. Because the moment you put in funds that you earn, even if, again, my name is on the W-2, well, it doesn't matter. Because the moment you are married in this community property state, every dollar earned in this household is seen as an effort from both the spouses in the household, okay? Doesn't matter whose name is on what, all right? Therefore, titling doesn't really matter in community property states. Okay, I just wanted to make that clear. Make sure you're not commingling things that you would like to keep separate after marriage. So, accumulate all the assets you want. Things like a home, it's a little messy, right? If you're still paying mortgage, oh, well, who's earning the money? Unless you got a completely separate account that was yours before marriage, you're using that $1 million checking account to pay off the mortgage. It's a little iffy. That's when you want to bring a lawyer in. But yeah, fun hypotheticals like that sometimes stick in your head. So moving on. So what is considered non-community property in these states? Any income earned by spouses prior to marriage, right? Kind of mentioned that. So income earned before marriage. Property that was received as a gift by one spouse. Okay, so if my mommy gifted me $17,000, then my spouse, is not entitled to that money. Well, I guess now with this next little bullet point I'm going to read to you, that wasn't a very good example, but property inherited by one spouse. So if my husband's mom dies and leaves him $1 million, that is his money, his discretion legally, right? Am I going to be too happy with him if he says that? and just goes and buys himself a couple Ferraris, I'm not going to be happy. But legally, I can't do anything about it, right? Is he going to sleep on the couch? Yes. But is he, legally in the wrong? Can I sue him? No. Okay. So I guess the better example for property received as a gift is, actually, no, the mom example works because my mommy's still alive. So she's gifting me $17,000. Okay. That worked. We're good. Clear. And lastly, any interest that's earned on separate assets that are held by one spouse as sole owner is considered non-community property. The best example, simplest one I can think of is, my husband has a CD that he bought before we were married, obviously with separate funds, and he's earning interest. That interest earned on that separate asset because my spouse just has it, in his name, he's a sole owner. That interest is not community property. But if he deposits that interest into a joint account or somehow commingles it, then we're going to have problems. But, the interest itself inherently is non-community, okay? So the main advantage to community property is that the surviving spouse is able to get a full step up in basis, okay? Which this only applies to long-term capital gain property, not ordinary income property. So, think of the house you live in. So the surviving spouse can get a full step up basis on stocks and the house, right? They can get a step-up basis in the entire property if at least one half of the whole property is includable in the deceased spouse's gross estate. So half of the property has to be included or includable in the deceased spouse's gross estate. And I mean, if you think about it logically, if it's included in the gross estate, it's most likely eventually going to get taxed. The IRS is going to get theirs. So then they're going to give the surviving spouse a step-up basis so that they don't get kind of sort of double taxed when the surviving spouse then dies. Okay, so think of it logically like that. In a community property state, right, I have my 50, my husband has 50, husband passes away and his 50, minimum 50, right, has to be at least one half of the whole property. His 50 goes through his gross estate, all that estate planning processes happen, which I'm sure we're going to be discussing soon. And his estate pays those taxes, done, IRS gets theirs. And they're like, all right, surviving spouse, you get a step up basis because we've, already had our fair share of this. So, here it is. Again, these are just ways to kind of remember things. It's not, bona fide fact. It's just how I like to think of it, to think through it logically, again, rather than memorizing. So that's all I have to say for community property states. Now let's discuss some titling for common law states. I just want to make it very clear. What I had just spoken about was community property. Now we are going to discuss titling in common law states. Okay, so just remember, in community property states, titling does not matter. Okay, the will is what matters, right? So now we are discussing states where titling does matter. So we're basically just going to go through all the titling. That's it, okay? So just remember, common law, titling matters. Community property doesn't matter. It's always 50-50. It's the will that actually determines who gets what goes where, okay? So I just wanted to clarify that before we jump in with all the different types of titling. Titling only matters in common law states. Sole ownership is also referred to as outright ownership or separately owned property. Separately owned property. Joint tenancy with right of survivorship, which is frequently abbreviated to JTWROS. This property can be held by spouses, parent, and child, or children, siblings, business partners, anyone, basically. The main characteristic of property that's held by joint tenancy with right of survivorship are, as follows. I'll give you a little list here. So unlike sole ownership, property that's held in joint tenancy with rights of survivorship is shared by several owners. So it's shared by multiple people. Control, ownership, and enjoyment of the property is shared equally by all of the joint tenants. Okay. The income from any income producing property is split equally, right? You notice the equal is coming up a lot, very key word. So income is split equally amongst all joint tenants. The distinguishing feature of this joint tenancy is the survivorship feature. So if a tenant dies, then the property immediately passes to the surviving joint tenants in equal shares. Again, there's the equal, okay? So immediately someone passes away, then their share is divided up equally amongst the surviving tenants, and that is that. There's no question. That is the structure of the titling. That is how it will happen. No one can argue otherwise, okay? The automatic survivorship feature makes it so that the property is not controlled by the terms set forth in any will, okay? So this is where titling really matters and the will really doesn't, unlike just community property states. So again, with joint tenancy with right of survivorship, the automatic feature is what makes wills kind of null, basically. The property is not controlled by the will, it is controlled by the titling in this case, okay? And the survivorship feature causes this property to be excluded from the probate estate of the decedent, which is a pretty big deal, okay? So if you have joint tenants with right of survivorship, the property that you had tenancy in is going to be excluded from your probate estate. And instead of memorizing that, just think through it logically. Probate estate is basically the estate that's the portion of your estate that's going to go through court, and the court's going to deliberate, who gets what according to your will and according to whatever, right? This skips that step. Why would the court need to determine who's going where with what in probate court with your probate estate if it is automatically and immediately passed to the surviving joint tenants in equal shares? There's no point in probate. Probate is not needed, okay? So it makes sense that it would be excluded from your probate estate. As if this is all not complicated enough, the estate tax implications of holding property with joint tenancy with right of survivorship, it's somewhat complicated. So the full value of the jointly held property is actually included in the gross estate of the first tenant to die, okay? Unless the survivor can establish ownership or consideration of some portion of the property before the joint tenancy was created. Okay, basically like have proof, have receipts. To avoid this tax consequence, all joint tenants should keep very meticulous records that prove the amount of their original contribution. Okay, so if you can't prove what you initially put into the property that's titled this way, then the whole dang thing is going to be included in your gross estate, unless you have very well kept records and receipts that show how much you had put forth, and then that much would be included in your gross estate. Okay, so that's a very important consideration in terms of this type of titling and estate planning. So unless the survivor can prove contribution, the entire amount is included in the decedent's gross estate, which is, a big no-no for estate planning purposes. So that is something to consider. But usually you wouldn't use joint tenancy with right of survivorship for business purposes. You would usually use tenancy in common, TIC, which we're going to discuss. So, this wouldn't really come up. This would only really come up if the client had already made this decision, titled this property this way, and it's a business property, or, something with your family and you guys don't really get along. And anyway, so we'll discuss that later. But yeah, So just remember that a gift of property is not considered a contribution or consideration. Actually, that was poor wording on my part. So a gift of property is not a contribution or consideration for the purposes of proving your consideration for the inclusion in your gross estate. So that was with non-spousal individuals. So if a married couple is the only joint tenant in this type of titling, then when the first spouse dies, their gross estate must include 1/2 of the property's fair market value as of the date of death. We just talked about that. So that also applies here for estate taxes. And then after which the surviving spouse would get the step-up basis. That is all for this episode. We discussed community property and common law states and how they differ. We discussed community and non-community property interest. We discussed titling that applies to common law states, such as sole ownership and joint tenancy with right of survivorship. And within that, we discussed non-spouse joint tenant estate taxes and spousal estate taxes.